So these are governed by International Accounting Standard 7. Huh? Notes. So you can open the notes. You can open the notes. Before we even go to notes, we need to understand what is a cash flow statement. So this is a statement that analyzes the sources and uses of cash in the business from the beginning of the period to the end of the period. So it's a statement that is prepared to analyze the sources and uses of cash and cash equivalent from the beginning of the period to the end of the period. So according to this statement, there are three ways in which an entity can use or generate cash. So number one is what we call the operating activities. The operating activities. And number two is what we call the investing activities. Investing activities. And number three is what we call the financing activities. Financing activities. So these are the three ways in which an entity can either generate cash or use cash. So operating activities, those are primary activities that an entity engages in. Those are the activities that an entity is organized or formed to operate in, to produce. So now operating activities include items like sales. When you make sales, you get money from sales. When you pay for expenses, you spend money from expenses and payment of taxes. So operating activities here, operating activities includes, you get the sales revenue, the amount of money that you get from the sales, you put aside here. And then there's this cost of sales. Cost of sales is the buying price, the amount of money that you use to buy what you sold, isn't it? So the amount of money that it costed you to buy the item, isn't it? And then you get here what we call the gross profit. And of course, you're going to spend money on operating expenses. So we have operating expenses here. Operating expenses. Operating expenses. So you're going to deduct here and get the net profit. Profit before tax. This is profit before tax here. And then you less tax that you paid. So you get now the cash that you received from operating expenses. And then now you compare if there is any increment with stock. You compare the stock that you had at the beginning and the one that you had at the, to see whether you had any increment in stocks. You also see whether you bought some. You also compare whether you spend money or received money through working capital. You know what is working capital? Working capital is a combination of current assets and current liability. So you now analyze whether there's any expenditure or income via working capital. Working capital is a combination of current assets and current liability. So you analyze whether you spend money on stocks or whether you received money as a result of sale of stock. And then whether you spend money through giving out more sales on debt, that is receivables, or whether the debtors paid in. So you come and analyze that, isn't it? So that is what we call operating activities, the primary activities of an enterprise. And then you check investing activities entail the purchase and sale of non-current assets. This one entails the purchase and sale of non-current assets. So an entity can either receive money through the sale or purchase of non-current assets. Non-current assets are those assets that stay long at the business. So you also analyze whether there's any movement of cash in or out through investing activities. Investing activities also include investment income like interest received and dividend received. So you also analyze if there is any receipts of income through investment income. Are we together? Then we have financing activities. Financing activities, those are capital to the business. So you check whether there's any inflow in form of capital in the business. Capital is received when you issue new shares, when you borrow more money, loan, and whether you pay interest on loan and whether you pay dividend. So the cost of loan is interest. And the cost of dividend is, the cost of share capital is dividend. So those are the sources of money. This is three ways in which an organization can either receive or spend money. So the cash flow statement is meant to analyze that flow. So now let us go to the notes that we have with that brief introduction. So according to the notes we are saying a statement of cash flow is a statement of analysis of movement of cash and cash equivalent from a start of financial year to the end of the financial year. So it analyzes the sources of and uses of cash and cash equivalent in the various activities undertaken by an enterprise. These activities include operating activities, just as I've explained, which involves trading activities of an enterprise, such as sale to customers, purchases from suppliers, payment for taxes. Those are the trading activities. And then two, investing activities, which entail purchases and disposal of non-current assets, in bracket PP, and other long-term investments. Investing activities also include the receipts of investment income, interest, and dividend received. And number three, financing activities, which involves raising of finances by enterprises through the issue of ordinary shares and debt instrument, debenture, loan stock, bond, etc. Now, after that, once you've known that what is the purpose of cash flow and how we can be able to generate and spend money in an organization, the next step is knowing how to present the cash flow. So the cash flow can be presented in two ways. There's what we call direct format and indirect format. So those are the ways. Mostly at your level, they require you to use the indirect format, which you're going to mostly to focus on. The most questions requires you to use indirect format. Now, indirect format. So it adjusts the profit before tax for the following. We have non-cash items of expenses and income. So those ones I'll explain the format through the use of a question. So the first question I want us to look at is November 2017. I want us to look at November 2017. November 2017, question number 2B. November 2017, question number 2B, cash flow statement. Is it November 2017? Question number 2B. November 2017, 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 question number 2B. So the question reads, the following information was extracted from the financial statement of Happy Time Limited. So you have the income statement for the current period. That is how they format this question. They will give you the income statement for the current period, and then they will give you the comparative statement of financial position for the previous year and the current year. So you'll be given three statements. One, you'll be given the income statement for the current year. And then you'll be given the comparative statement for the last statement of financial position for the previous year and the current year. Are we together? Question number 2B. Huh? November 2017, question number 2B. Yours is not there. It's not the same. They're the same. November 2017. Question number 2B. 2B or 3B? Or 3B, sorry. It's supposed to be 3B. It's supposed to be So November 2017, question number 3B. So I was saying the format of the structure for the question of cash flow is you'll be given the current income statement and the statement of financial position for 2 comparative years, the current year and the last year. Then you'll be given some other additional information. Like in this one, we have been given the additional information relates to the property, plant, and equipment. And then number 2, planned disposal of during the year ended 30th June 2017 has an original cost of 18,200 and accumulated depreciation of 6,300. The disposal proceeds amounted to 5110. The dividend were declared before the year ends. So required statement of cash flow in accordance with the National Accounting Standard, statement of cash flow for the year ended 30th June 2017. So you use the indirect method. So now how do you approach this question? The first thing, always when you get the statement, once you know how to analyze, how to prepare this non-current assets account, you start by analyzing non-current asset account. Why? To find out if there is any disposal or acquisition of non-current assets. So you start with the non-current assets. You go to the non-current asset there. So you have been given the non-current asset, they have given us, they have lumped them together and they have called them property, plant, and equipment. They have given us the breakdown of that property, plant, and equipment in note number 1. So we'll start with the property. So they have property there. You start with this one. You have property here. So you write there property. So this one, you can either use the cost or you can use the net book value. So we're going to use both. In this question, we're going to use the cost. In another question that we're going to use, you're going to use the net book value, and we're going to see the difference. So it's very easy. The first thing here you pick, you take the balance board down, the last year's figure for property, plant, and equipment. The last year, the cost, which is 58,800. So you pick 58,800. This was the opening balance of the property. Is it so? 2016. Everybody? Yes. And then you pick the closing balance carried down for 2017, which is 78,400. And then you identify other item that relates to this property. You identify other item that relate to this either through additional information. So other item that goes here, maybe there is a revaluation. You need to check whether there is a revaluation. That is number 1. How do you know that there's a revaluation? They can explicitly tell you that the asset was, this property was revalued. Or you go to the statement of financial position, you check revaluation reserve. You check the last year's revaluation and this year revaluation. You check. Now there is an increment. Last year it was nil. This year it is 3,500. You go under equity and liabilities in the statement of financial position. You check for 2016. Can you see? The revaluation reserve in the statement of financial position under equities and liabilities. We have revaluation reserve there. Have you seen it? So now that revaluation reserve is showing you at the beginning of the year it was nil figure. And then at the end of the year it's how much? 3,500. So what it means, they revalued their property. To revalue means to adjust your property in accordance with the market value. Okay? So it was now, when you revalue asset upwardly, the double entry for that is you debit your asset to recognize that surplus, and then you credit your revaluation reserve. That is extra capital. Okay? So they have credited the revaluation reserve. So you come here and indicate here 3,500. So those are the items posted in this property, isn't it? And then another item that is posted here, you check if there is any list item. In this question, there was none. They list none, isn't it? Okay? 3,500, yes, it is 3,500. 3,500. Unaona ngapi? Unaona ngapi? Wewe unaona ngapi? Your neighbor. You are seeing 35. So it means this asset was revalued upwardly by 35, isn't it? So you debit the asset and you credit revaluation reserve. Revaluation reserve is capital. Like for instance, this building is yours, isn't it? According to you, maybe it is valued 10 million, isn't it? But you call in expert who know how to value things. They tell you, no, it's not supposed to be 10 million. It's supposed to be 15 million. You see, this extra 5 million is additional capital to you. Now, if you were to sell that asset according to the revalued figure, you'll sell 15, not 10. So you see, you've gained an additional how much? 5 million. So how do you treat this one in accounting? You debit the asset and you credit revaluation reserve. So once you get that they have credited revaluation, there's an increment of revaluation reserve. then it means it affects the property, plant. So you debit there. Is that okay? And then you also find out if there is any item that was leased, you add there. Leases, isn't it? And you check additional information if there is information that affects this account. Sorry? To lease is to rent out an asset, isn't it? When you lease it, you recognize it as yours for the lease period. You recognize it as yours, isn't it? So you check if there is any asset that is also leased, you add there. You also find out from the additional information if there is any information that affects this account. Okay? If there is none, now you come and compare. Now this one, for this particular account, we don't have any other information. You compare now this side and this side. If this side is greater than this, the balancing figure is an additional asset that was bought, that was acquired through purchase. If this side is greater than this, if the debit is greater than the credit, the balancing figure is an asset that was disposed of. So the purpose of opening this account is either to find an asset that was acquired, the amount of money that was used to acquire a new asset, or the amount of money that was spent the asset that was disposed of. So your work is very simple. Pick the opening and the closing balance. Identify the other information that is relevant to this account, like revaluation and leases, and then just compare the two sides. Now, like here, they are saying we had this opening balance at the beginning, isn't it? And then we added this one, isn't it? So what do you expect? This plus this at the end, isn't it? So when you add the two, do you get this figure? No, this one is greater than the two, isn't it? What happened that we have a bigger figure than what you expect at the end? The balancing figure is bang, they acquired another one, the balancing figure. So that is the essence of that. Sawa sawa? Nani hajaelewa hiyo? Tumesema kazi yako ni rahisi sana. Chukua ile opening balance na closing balance. Enda angalia kama kulikuwa na revaluation. Weka hiyo revaluation pale. Angalia kama waliakuwa na asset nyingine kutoka kwa lease. Kwa kama walilisa asset nyingine, weka hapa. Sawa? Kama hakuna information nyingine, unakuja unakombea hii side na hii. Kama hii side ni kubwa kushinda hii, ile balancing figure inaitwa purchase, walinunua. Na ukinunua asset pesa unalipa kwa bank. Sawa? Kama hii side iko kubwa, that is side kushinda hii, the balancing figure hapa ni disposal. Kama unatumia cost, So the essence of this account here is to find the asset that was acquired or the disposed asset. And for you to do that, first of all, make the posting the way they are supposed to be posted. Can we get this balancing figure? So in other words, 16, 100, 78, 400. Are we together? That is working number one. And then working number two, when you maintain this account at cost, the way we are doing, you must also open accumulated depreciation for the same. Accumulated depreciation. Accumulated dip. Why do you open this account? You want to know the total depreciation they charge for the asset, for this property, for that period. So you take the opening balance of the accumulated depreciation, which would be the credit. You pick the opening balance. Balance go down was how much? For accumulated depreciation property is 9,100. Can you be able to see it? Depreciation, isn't it? And the closing balance there, balance carried down is how much? 10,780. Very easy. So if there is any disposed, maybe there was disposal, you will determine what was the total charge on the asset that is being disposed of. You eliminate here. This one had no disposal. So now the question is, this was the balance that we had at the beginning, and we have a greater figure at the end. What happened? That is what was charged in the income statement as profit and loss. The difference, which is how much? 1680. So this one is 1680. So 1680, when you add this one, you get 10,780. 10,780. Napata hivyo. Yes, yeah. So that we have now through with the first asset. You must analyze, you must know how to analyze. Once you know how to analyze these assets, you are done with cash flow. Ukijua hiyo umemaliza na cash flow. Tuende working number 3. Working number 3 it is planned. So you open the account for planned. You open the account for planned here. Planned account. So you pick the opening balance, cost. Remember, you're using cost. You pick the opening balance for planned, last year's figure, which is 75. Sorry, it is 75 for 2016. It is 75,600. Is it so? 75? The opening balance of planned, 75,600. The closing balance, the cost. The closing balance, Kyoko. You cannot be able to see it. 98,300. Who won you? 93? 93? Everybody can be able to see this figure. Kazi yako ni rahisi sana. Usingangane na hiki kitu, wewe chukua tu hii na hii kwanza. And then you go to the additional information, unaangalia information in affect your account. Unaangalia, you read it. Like in information number 2. Planned disposal during the year ended 30th June 2017, an original cost of 18,200. So they disposed of a plant during the year, whose original cost was 18,800, isn't it? Remember, we said when you dispose of a plant, what do you do? What is the double entry for that? You credit the asset account and you debit dispo with the original cost. If you're making this one at original cost, so you eliminate the one that was sold. You say here disposal. 18,200, you are disposed of, isn't it? So now here, already we have disposal. This was the opening balance. This is the one that disposed, isn't it? If you take this figure and you deduct this one, you see this one will still be greater, isn't it? This is what you had at the beginning minus what you sold. You expect a lower figure than what you've been given, isn't it? But you've been given a higher figure. Why? It is because they acquired another plant. So the balancing figure here is bank. So you'll add this side and this. How much you get? 16? 86? 86,100. Sorry? 36,400. So the total will be how much? $112,000. So this is 112,000. And every time, and then you all open here accumulated depreciation account. So we have accumulated dip account. So the balance brought down for accumulated depreciation is how much? The balance brought down for accumulated depreciation for planned is 23,000. Can you see it? The balance closing balance for depreciation is how much? 34,300. Are you able to see those two figures, isn't it? And then you eliminate the total depreciation on the asset that was disposed of. The asset that was disposed of had its depreciation accumulated. So because it's no longer in the business, you eliminate its total depreciation charge. Note number 2, planned disposal during the year ended 30th June 2017 had an original cost of 18,200,000, which you're saying it's 18,200, and accumulated depreciation of how much? So the total accumulated depreciation on the plan that was disposed of was 6,300. This figure is in this opening balance of 23,000. So we eliminate it. So we write here disposal, which is 6,300, isn't it? Now we find out what was charged in the income statement. So you take the opening, the 2. This is the opening balance minus what we disposed of. We still have a greater figure at the end. What happened? It is a charge. So this is how we determine the depreciation charge for the period. So we can either open this account to determine the total the disposal value. So this account will help us to determine the sometimes disposal value on the other, that is the total charge on the disposed asset, or the charge during the period. So now this one is the charge during the period. So when you see a question giving you these three figures, they want to determine this. Okay? If they give you these three, they want you to determine this. So you can use this account to determine this or this, depending on what you're given in the question. Some question will give you this. How much is this one? The balance figure? Huh? 78,600. So 78. 7,600. So that is total, you know, isn't it? And every time there is a disposal of an asset, you must also open a disposal account. So there are three accounts that you sometimes open in regard to non-current assets. So you'll open the planned account itself. You also open this one and disposal accounts. So once you know how to operationalize these three accounts, then you'll have no issues with cash flow. So you have to open a disposal account every time there is a disposal of an asset. What is the essence of opening this account? The purpose of opening this account is to determine whether the asset was sold at a profit or loss. So as I was explaining here, the examiner sometimes can give you these three figures in order for you to get this. When you're given these three, they want you to get this. So your work is very easy. Just post what you've been given. Whatever is missing is what they want you to find. To Melana. So now here we have the cost of the asset that was disposed of. Here we have written here disposal. Where is it? 18,200. This is the cost. And then accumulated depreciation here was 6,300. Where is it? You see, 6,300. And then the received. And then the proceeds here. Proceeds, how much is it? 51.10. So how much is it? If this side is greater than this, is loss on disposal. Loss on, so this is loss. Loss on disposal. Loss of how much? 67.90. So 18,200. 18,200. 18,200. So can you add this 7,600 plus 1680? How much do you get? 7,600 plus 1680. I'm saying add this one. This 7,600, 19,280. So you can also sometimes okay, accumulate. You can accumulated dip. So balance brought down the total accumulated dip balance brought down was how much? 134, 32,900. Umona. The total 32. Balance carried down is how much? Balance carried down is how much? 45,080. Disposal is how much? 6,300. Sometimes you also compare the total against individuals. If there's difference, then you take the total to be the depreciation for the year. Like this one is 7,600 plus this, you compare with the total. The total, so you take this one as the balance, then you eliminate this one. So what will be the balance figure? $18. So here we write here profit and loss 1848. So now you need to know how to operate these accounts. Once you know how to operate these accounts, how to post and determine what is required, then you are comfortable now. You can do cash flow very easy. So what do they test here? They test students to determine either for asset, they want to know whether you can be able to determine the amount of money that was spent to acquire a new asset or the asset that was disposed of. So you use this account by picking the opening and the closing balances. You check if we have any information regarding to revaluation or new, and then you balance off. So if this side is greater than this, the balance figure is disposal. If this side is greater, the balance figure is acquisition. Once you have done this, you now go straight away and make your cash flow statement. So write Happy Limited. That is the name of the company. Happy Limited. Cash flow statement. Cash flow statement for the period. Ended 30th June 2017, and then you underline. So you start with the cash flow from operating activity. So you write here cash flow. This is the format, and this cash flow from operating activities. And then you underline here. So you write here shillings and thousands. So you start with profit before tax. You pick your profit before tax. Now from the current income statement. Profit before tax is how much? 25,032. Can you be able to see it? 25,032. You've seen it? And then your adjustment here, you write here adjustments for non-cash items and non-operating items. Adjustments for you adjust for non-cash items. So we have some other non-cash items that are deducted from the gross profit, like depreciation. What do we mean by non-cash item? There's no movement of cash in or out, isn't it? When we depreciate an asset or we provide provision for depreciation or provision for bad debts, there's no movement of cash. But you remember now, we have treated that one as an operating expense, isn't it? So we have deducted from our operation. So we add it back. And then we also have some other non-operating items, like maybe finance cost. Finance cost is the interest that is paid on loan. It should not be deducted from the operating activities. It's supposed to be deducted from financing activities. So you check if those items exist. Like here we have depreciation. So you add back depreciation. That is an operating item. The total is 18,480. So you come here and add 18,480. Tumeelewana? And then we also have loss on disposal. Loss on disposal. Why are we adding back here? Because they had deducted this one. Yet it's an operating item. There's no movement of cash. Remember, the essence of cash flow is to determine the movement of cash. That is the essence, isn't it? So if there is any expense that was treated and yet there's no movement of cash, that one we add it back. Like now loss on disposal. When there is loss on disposal, there's no movement of cash in or out. So there's a loss of disposal of how much? Where is it? 67. So we add back 790. Tumeelewana? And then we go and check. We check. You see, when you check down the income, the current income statement, they have deducted their finance cost. Can you see? Finance cost falls under financing activity. So here they have deducted. So you add it back. So here you identify those items that do not belong to operating activities, and those ones that do not involve movement of cash in or out. If there is gain on disposal, you deduct because they will have added it. Then you get the cash flow before working capital changes. Cash flow before working capital changes. Working capital. You get cash flow before working capital changes. So you add these figures. What do you get? When you achana jirani yako. Ngapi yako? 26 138. 26 138. Jirani yako na sasa mpata ngapi? Jirani. What is the value there? 36 188. How much have you got? Yeah, tuongeza profit before tax. Unaanzia hapa. So hii ni ngapi? 51 170. And then we less tax paid. How do you determine the tax paid? You go to the statement of financial position. We had tax payable. They had an owing tax payable of 47.90. They had an opening balance of tax to be paid of 47.95. You've seen it for 2016. And then the current tax is supposed to pay, income tax expense in the current income statement, it is plus the one that is supposed to pay currently is 72.80. So they're supposed to pay 72.80. And then you less the closing balance of 72. This one is coincidental. They're not always. So this is the tax they had arrears, the balance breakdown of tax they're supposed to pay at the beginning, plus one they are supposed to pay in the current year, isn't it? Minus now the closing balance. So the difference is what they paid. Tumeelewana? The one they had at the beginning plus what they're supposed to pay this year minus the closing balance. How much will that be? How much will that be? $47, 72.80, 47.95. And then we less there, you get cash inflow. So the answer here is cash inflow if it is positive. Cash inflow from operating activities. Cash inflow from operating activities. So when you deduct what you get? Cash inflow from operating activities. So can we deduct this one? $46,375. Is it okay? Huh? Nani mwingine amepata different na yeye? Huh? I think you're making some mistake here. Before we even go to, that is 46 how much? Before that, before even we analyze the changes, I think we are missing here a step. Once, okay, at this point, when you arrive at the cash flow before working capital changes here, then you analyze working capital changes. You're supposed to analyze working capital changes. You come here and analyze working capital changes. You analyze working capital changes. So working capital changes, we said you analyze the movement of, sorry, there's a mistake here. Working capital changes. Working capital means the capital asset plus current assets and liability. So you go analyze the inventories. Tumemalizana na current asset tunaenda kwa inventories. So you just check the 2016 and 2017. If an asset increases, that is an outflow. If it reduces, that an inflow. If an asset increases, that is an outflow. If it reduces, that an inflow. So now increase in inventory. So you write here increase in inventory. Increase in inventory. The 2016 figure was so 11,200 minus 7,700. What is the difference? Gapi? 3,500. That is outflow. It means they use more money to buy inventory. Then you go to the trade receivables. So you say increase in trade receivables. Increase in trade receivables. How much is it? Increase in trade receivables, we had 5,000, 10,500 minus 5,600. So you compare the current year's figure and the last year's figure. If it is increasing and it's an asset, the difference is outflow. So how much do you get? Sorry? 4,900. That is outflow. That is outflow. And then you skip the bank. You go to the current accounts payable. Accounts payable, there is a decrease in accounts. Decrease in accounts payable. The account payable is decreasing. The account payable is decreasing. If it decreases, if it's a liability, if the liability is decreasing, then it means this outflow of money. If it is increasing, then it means there is 1,600. 1,600. So what do? 700, isn't it? So this 700, that one you deduct. That's how. Then you get here what you call cash flow from cash flow generated from operating activities. So now you add this one, you add this one. This one is negative. So this is 51,170 plus 3,500 negative 3,500 plus negative 4,900 plus negative 700. What do you get? $20? For 20 from here. For 20, 70. Now then you less tax paid. You less tax paid. Tax paid, you said you pick the opening balance, which is 4,200. Is it 4,200? No. It is 47.95 plus the current balance, which is the current tax to be paid, which is 72.80, minus the closing balance, which is 72.80. So that is how we determine the tax paid. You pick the tax that is to be paid at the beginning, you add the tax to be paid the current year, you compare with the closing balance. The difference is what is to be paid. Can you do that one? Huh? 47.95, isn't it? So you less net cash inflow. Here you get net cash inflow from operating activities. How much will it be? 37,275. Here you minus here. Then you write here cash flow from. Now you analyze cash flow from investing activities. Cash flow from investing activities. So you write here purchase of property. Purchase of property. Purchase of property, which is 16,100. That is outflow. And then there is purchase of plant. Purchase of plant. This one, which is 36,400. Outflow. Then sale of plant. Received 551,110 for sale of plant. Tumeelewana? Hapa tulikuwa tunadetermine kama walinunua plant ndio hiyo walinunua. Ndio hiyo ni outflow. Si ni kweli? The reason why tulifungua hii tulisema tunataka tuangalie kama walinunua plant ama hapana, si ndio? So tukapata walinunua plant, ndio hiyo ni outflow. Tulisema investing activity entails those activities that involves purchase and sale of non-current assets. So when you buy non-current asset, that is an outflow. When you buy an non-current asset like this one, that is an outflow. when you sell non-current asset, the amount of money that you receive for the sale is an inflow. Si sawa? So kiadi unafanya ngapi? $57? 57, 16. Negative. 57, 610. Negative, isn't it? Are you sure? These two are minus. 47, 8? 47, 39. Negative, Right here, net cash outflow. Net cash outflow from investing activities. Then you cash flow, you write here, you come and analyze cash flow from financing activities. You analyze now cash flow from financing activities. We said financing activities involves activities where we can either receive money from capital. So you go to share capital. You compare the opening balance and the closing balance. So if it increases the way it is, you say here, issue of shares. Issue of shares. So the issued shares, what is the difference? 35,000 minus 45,500. Issue of shares. You compare the share capital, fanyeni haraka tuende bana. 35,000 minus 45,500, ngapi? You compare ile ya 2016 ni 35,000 share capital. So umeona? Na 2017 ni 45. So unaona ime increase. So if it is increasing, then it means 10,500. So that is an inflow. 10,500, that is. And then you say issue of shares at a premium. Issue of shares at a premium. Issue of shares at a premium. So the premium, the difference was 19,705 minus 26,838. What is the difference? $71.33. So that is an inflow, $71.33. So that is inflow from capital. There was an additional capital. And then you go and check loan. If the loan is decreasing, the repayment. If the loan is increasing, is acquisition of new loan. So right here, repayment of loan. Repayment of loan. There was an outflow through repayment of loan is a financing, it's a financing item. So the amount of loan at the beginning of the year was 23,100. At the end is 16,100. What is the difference? 7,000. So that is an outflow. You put it in bracket. And then now you go to, you check the, you want to determine the dividend that was paid. So dividend paid here. Dividend paid. So you pick the opening balance of dividend. The opening balance of dividend was supposed to be 4,200. You add the dividend is supposed to pay this year, which is 7,700 from the current income statement. Then you compare the closing balance of dividend, which is 4,900. Are you able to see those figures? This is the dividend that was there that was supposed to be paid at the beginning of the year, plus what is supposed to be paid this year, minus the closing balance. The closing balance is how much? 4,900. So how much is that? Huh? 4,200 is the year 2016. Dividend payable, 4,200. Umeona? 2016. So how much is it? 7,000. That is an outflow. And then now you let's see a finance cost. Finance cost at this point, we added it back because it does not belong to operating activities. But you subtract here, 868. And then you get the net cash. You add those ones. What do you get? 27. Here. 27. Negative or positive? Positive. So you say here net cash inflow from financing activities. Then you get the changes in cash and cash so changes in cash and cash equivalent for the year. So you're going to add these figures. You're going to add this, this, and this. You're going to add 37,275 plus negative 47,390 plus 27,65. What do you get? You get what it changes in cash and cash equivalent for the year. So you're going to combine the net cash inflow or outflow from operating activities. You are going to add it to the cash inflow or outflow from the investing activities. And then you are going to add it cash and cash, either cash inflow here. So you're going to add those three figures. When you add, what do you get? 87? Here 87 for 30. Are you sure? It can't be 87. This is a negative figure. Negative? 74.30. 74.10. Negative. What is the problem? So to add this figure to 137,275 plus negative 47,390 plus positive 27,65. What are you getting? $73,50 like that. Yes. Then you're going to add cash and cash equivalent. Cash and cash equivalent balance brought down. So which is, you're going to check the cash and cash equivalent. What do we mean by cash and cash equivalent? Cash equivalent is any investment that can be converted into cash very quickly. Like maybe if you have investment with the treasury bond, you have a certificate of a bond investment. Even if you go to the bank with that certificate and then they authenticate it to determine it is originality or it is accuracy, it is validity, then you're given cash immediately. So anything that we call cash equivalent, it means it can be converted to cash very fast. So that one includes the money in the bank or cash and any marketable security that you have them. So now in this question, we only had bank balance. The bank balance at the beginning of the year was 8,400. So you add 8,400. What do you get? So you should now, when you add, you should get the closing balance, cash and cash equivalent. Balance carried is 1050. So when you check in your statement of financial position, you will realize the closing balance is 1050. So in other words, we are able to analyze how they came about with the closing balance of 1050. Tumeelewana? So that is how we prepare the cash flow statement. Very easy. Can you now maybe copy that question? You want to copy it to screenshot it? You can screenshot it very fast. We'll do another one. Before you will do this, before you screenshot, any question? Any question? Eh? Revaluation, what about revaluation? Kwa. Eh? Tutaangalia swali lingine tena. No, sales, it's already been combined to get the profits. To get there, you've taken your sales, and then you've minused your expenses, isn't it? To get your profit, is it so? Yeah. To be. So the question reads, the following are the statement of financial position of Point Limited as at 1st December 2017 and at 1st December 2018. Statement of financial position. So you've been given the statement of financial position for 2017-2018. Then additional information, Point Limited's profit after tax for the year ended at 1st December 2018 was 2180,000. Number two, the property, plant and equipment in the books of Point Limited as at 1st January 2018 had been acquired at a cost of 7290. The company's depreciation policy is to depreciate all assets at the rate of 10% per annum on straight line basis from the date of purchase to the date of sale. On 1st September 2018, One Limited sold an item of plant which had a net book value at that date of 520,000. The item of plant had an original cost of 800,000, and the company made a loss of 20,000 on the sale of this item of plant. Number three, the company finance costs and income tax expense for the year ended at 1st December 2018 amounted to 48,000 and 60,000 respectively. Required statement of cash flow in accordance with IS 7, statement of cash flow for the year ended at 1st December 2018. So it is the same. So here we're going to open working number one here. We're going to open what you call, here we have been given, you start with the property, plant and equipment. So we have property, plant and equipment. We call it PPE. So this one we're going to use the net book value. So we're going to see the difference between using the net book value and the cost. So we're going to pick the figures as provided in the statement of financial position. The opening balance, the balance brought down for last year, 2017, was how much? 5910. And then you pick the closing balance for the current year, which is 7680. That is the first thing. And then you check if there is any revaluation reserve. Revaluation surplus, no. So it is 120, 120. There's no increment, isn't it? If there's any increment, you add here. When you're using the net book value, you eliminate depreciation and the net book value of the asset that is disposed of. That is the difference. So you eliminate the depreciation charge for the year and the disposal, the net book value of the asset that is disposed of. So let us identify those items. Number 2, the property, plant, and equipment in the books of One Limited as at 1st January 2018 had been acquired at a cost of 72,90,000. So the company's policy on depreciation is to depreciate all assets at the rate of 10% per annum on straight line basis from the date of purchase to the date of sale. On 1st September 2018, One Limited sold an item of plant which had a net book value of how much? Net book value at the date of sale of 520. So here disposal here, you write here disposal. And you must make sure it is a net book value. Net book value means cost minus accumulated depreciation. So the net book value of the asset that was disposed of is how much? 520. Net here 520. In some other questions, they will just give you the cost and the accumulated depreciation. So it is you to compute the NPV. And then now deep charge for the year. Deep charge for the year. So their policy for depreciation, % on cost. 10% on cost. That is their policy on depreciation. So the property that was there at the beginning was 7290. Can you be able to see it? 72? Can you be able to see it? 72? You eliminate the cost of the one that was sold off. The one that was sold off, the original cost was 800. Because it's already sold, you eliminate it from the original value, isn't it? How much will you get? 10% of 7290 minus 800. So how much do you get? Eh? 9 here, isn't it? We're also being told the asset also you depreciate in accordance to how it was used during the period. The financial year runs from January to December. The one that was disposed of was disposed on 1st September, isn't it? So meaning it was also used for 8 months. Is it so? The one that was disposed of, his original cost was 800, isn't it? According to their policy, the company's depreciation policy is to depreciate all assets at the rate of 10% per annum on straight line basis from the date of purchase to the date of sale. So this one that was sold, it had already been used for how many months? 8. So we're going to determine depreciation for that period. So we're going to add here 10% of 800 times 8 out of 12. That is the depreciation charge for the year. Gape? 53, isn't it? Yeah. So now what is the difference between maintaining this account using the net book value? When you're using net book value, the disposal value here must be the net book value of the asset disposed. When you're using cost, the disposal value is the original cost. Are we together? And then you must also eliminate the depreciation charge for the period. That is the difference between using the net book value and the original cost. Now you compare this side and this one. If this side is greater than this, the balancing figure, which is this side that I'm talking about. I'm talking about now you do the comparison between the credit side and the debit side. Difference if the credit side is the greatest bar acquisition now. How much is it? Now, how do you know when to use the cost or the net book value? If you've only been given the figures in the statement of financial position, those one, it means they are net book. If you only have figures that are indicated only in the statement of financial position. In the statement of financial position, we indicate the figures at their net book value. I hope you know that, isn't it? So if you've been given the figures here, these are the ones that you're using, then automatically using the net book value, which you must remember to do these two things. Now the bank here will be how much? 3280. Add this plus this plus this plus this minus that. What do you get? Eh? 29.92. Total is how much? 89? 8902. 8902. Any question on this account? You're the one asking revaluation. We said if there is any revaluation on property, revaluation is where you're comparing the net book, the book value and the market value. And they will indicate if there is any surplus. We said we sometimes call in valuers to determine the correct value of our assets, isn't it? There's what we value them according to our accounts books, and there's what the market value them according to the market rates. If there is difference, which is mostly the obvious, isn't it? So you add that difference to your assets to make it there, to adjust to the market rates, the market value source. And then now here, you don't need now to open the accumulated depreciation account. You just come here and open the disposal account. If you're maintaining the disposal account here, if you're maintaining them at net book value, so you pick the opening balance, the balance go down. Sorry, not the balance go down. So the net book value of the asset that was sold, which is 520, isn't it? And then we are told that it was sold at a loss of how much? We were told that it was sold at a loss of how much? 20. So loss here, profit and loss account here. Loss of 20. So the purpose of opening this account is either to get this loss or to get the proceeds. So if you've been given the loss, then they want you to get the proceeds. So the proceeds here will be how much? 520 minus 20, 500. This 520, this 520 is the value at which the asset that was sold they had in their books. This is the value at which they had attached there to the asset in the books. The value of the asset that was sold off according to their books. But they sold it at a loss of 20, isn't it? So meaning they sold it how much? 500, isn't it? Yeah. So now I think we can be able to make our cash flow statement. We can make our cash flow statement. So we write here Pwani Limited. So Pwani Limited. Pwani Limited. Cash flow statement for the period ended. For the period ended 30th September 2019. So we write here shillings and thousands. Remember to write that one. So we said here we get the profit before tax. So we've been given the profit after tax, which is 2180, isn't it? One limited profit after tax is 21, not number one. So 2180, and then you have been given the tax. Tax is how much? 63, not number 3. So we add 63, isn't it? Not number 3 tunaambiwa tax ni ngapi? So to add profit after tax, to add tax, tunapata profit before tax. Ni kweli? So unapata ngapi? 2180 plus 63. Kuja? 2243. And then here we get the adjustments for non-cash items and non-operating items. So we write here depreciation. Depreciation, we add back depreciation. Depreciation is 649 plus 50, which is depreciation charge for the year, which is how much? 7K. 702. And then loss on disposal, we add back loss on disposal. Loss on disposal is how much? 20. And then note number 3, we had finance cost. Finance cost, how much is it? 48. So we add there 48. So we don't have any other item here. So we get here cash flow before working capital. Cash flow before working capital changes. How much is it? 23. Then here we analyze the working capital changes. Working capital changes. Working capital changes. We go to the current assets, inventories. There's an increase of inventory, increase in inventory. How much is it? The difference? To 40. Inflow, outflow. Outflow, isn't it? Increase in trade. Increase in accounts receivable. Accounts. Increase in account receivable. How much is it? 1020 minus 1170. 150. You deduct that one is an outflow. And then you go to accounts payable. Is it increase or decrease? Decrease in accounts? Decrease in accounts? Decrease in accounts payable. How much? 42? 42. Outflow, inflow? Outflow, inflow? Outflow. Decrease, isn't it? Sasawa. Sawa, tutoe hizo tupate. Can we add all those 2311 plus 240 plus minus 150? What do you get? So 702. 702 tuna add. Hii 2243 tuna add hizo zote. Tunapata hii. Tunapata ngapi? Are you sure? Tuna add hii na hii na hii na hii. Tunapata 3013. Nani alisema hii figure 30? Is it true? Tumia calculator. Hiyo utumie kichwa. 3013. Aha. 3013, si ndio? Aya, ukikuja hivi unapata ngapi hapa? 2581. 2581, si ndio? And then you less tax paid. You less tax paid. So the current tax, you pick the last year's tax, which is 90 plus 63 minus 150. So you know what? This is last year's. How much you get? Free. So you less this one 3. So you get the net cash inflow from operating activities. Now we are happy. 25. Not 24. 2578. 2578. 25? And 578, isn't it? And then now here we analyze cash flow from investing activities. Cash flow from investing activities. So we have purchase of PPE, purchase of property, plant, and equipment, which is 2992. This outflow. Then we have the sales of PPE, sale of property, plant, and equipment, which is the amount of money that was received. The amount of money that was received. So we had only those two items. Is it so? So we had only those two items. Then we get the net cash outflow. Net cash outflow from investing, which is how much? 702 minus 2992. Oh, 24 negative. Then here we analyze cash flow from, okay, let me write here, cash flow from financing activities. Cash flow from financing so we check the shares. So we have issue of shares, issue of shares. Issue of shares, how much? 60. That is an inflow. Mona, we're comparing last year's figure and this year. There's an increment of 60. That is an inflow. Issue of shares at premium. Issue of shares at premium. 75. That is an inflow. And then we check at loan. Loan, the opening balance was, so repayment of loan. Repayment of loan. How much is it? Repayment of loan, 2,400 minus 2,250. 1. That is an inflow. And then you're going to determine the dividend that was paid. Dividend that was. So how do you determine the dividend that was paid? You check the retained earnings. Dividend paid, you check the retained earning when you don't have dividend. Dividend paid. So how do you determine the dividend paid? The retained earnings, balance go down last year's figure. Last year, unachukua retained earning last year, which is 6303. Sasa plus ya this year, which is 2180. 21 profit after tax ya this year ni kwa ngapi? 2180. Si ni kweli? Minus the current year's closing balance, which is 5697. That is how you get the dividend. So dividend, if you've not been given the figure for dividend payable, you use the retained earnings. You take the retained earnings at the beginning plus the current retained earnings minus the closing retained earnings. What do you get? $86. So that one is negative. Then we have finance cost. Finance cost, how much is it? Finance cost, it was 48. So you add there, here you subtract. And then now you add those figures. What do you get? Napata ngapi? 60 plus 75 plus minus 150 plus minus 86 minus 48. How much do you get? Eh? Wacha kumwangalia wewe. Mbona huu hadi yako? Ama unasikia njaa? 190? Ati 149 au 194? Net ni positive ama negative? So tunasema net cash outflow from financing and then you add cash and cash equivalent balance brought down. The cash and equivalent operating balance. So we had a cash of how much at the beginning? We had a cash of how much? 168, eh? And then you deduct the overdraft of 90. Overdraft of 90. Bank overdraft of 90. 168 minus 90 nakuja ngapi? Sorry, a cash. Before we do that, we need to have the cash and cash equivalent. So we have cash and cash equivalent for the year. Cash and cash equivalent for the year. Cash and cash equivalent for the year. So we're going to add, which figures are we going to add? 578 plus negative 2492 plus negative 149. Kiadi hizo unapata ngapi? Cash and cash equivalent for the year. Negative 63. Like this. When you add this to what do you get? Negative 149 minus negative 6. Oh, sorry, this is the cash and no, sorry, you are right. So negative 63. Then you add cash and cash equivalent. Cash and cash equivalent balance brought down. So we are saying this balance brought down is 168 minus 90, which is which is 78. So when you add minus 63, what do you get? Cash and cash equivalent balance, cash and cash equivalent balance carried down. What do you get? 15. Negative or positive? Positive. So you confirm the current cash balance is 75 minus the bank overdraft, which is 60. You get still 15. So that is how we do the cash flow. Tumeelewana? The current cash balance is 75 minus 75 minus 60. Bado utapata hiyo. Any question? Any questions so far? So assignment December 2021 question number. Assignment December 2021 question number 3B. December 2021 question number 3B, assignment. Assignment December 2021 question number 3B. So December 2021 was number 3B.